Good morning, everyone. It's my pleasure to host this next session on the Monetary and Fiscal Nexus and Unintended Equilibria. I'll introduce our paper presenter shortly, but let's take a quick step back. Mervyn King once said, "Central banks are often accused of being obsessed with inflation." This is untrue. If they're obsessed with anything, it is with fiscal policy. And I think this aptly summarizes the important role played by fiscal policy for the conduct of monetary policy. Without a stability-oriented fiscal policy, it becomes very hard or almost impossible for central banks to safeguard price stability. But of course, the reverse is also true. The behavior of monetary policy is crucial for fiscal policy. The level of interest rates critically determines the sustainability of government debt and fiscal space. And it's therefore no surprise that politicians in the more distant but also recent past have made their preferences clear on the appropriate level of interest rates. To address negative side effects of disincentive structures, many countries have set up institutional frameworks for monetary and fiscal policy, in particular central bank independence, as well as budget and debt rules in the fiscal area. All in all, the interaction of monetary and fiscal policy is key for macroeconomic outcomes. However, it also seems like it doesn't seem to follow a deterministic path, as the case of Japan and Switzerland would seem to illustrate. From a Swiss perspective, the low level of inflation and interest rates that Japan has been facing for decades looks very familiar. However, government debt levels are quite different. In terms of inflation, and despite the recent increase in oil prices in the wake of the war in Iran, inflation in Switzerland has reached just only 0.6% in April, and the policy rate is at 0% and has been so since last June. In terms of fiscal policy, however, the level of general government debt stands at 40% of GDP in Switzerland. On a global level, however, the fiscal situation looks less benign. The IMF estimates that the level of current government debt in advanced economies is close to 110% of GDP and close to 125% of GDP in G7 countries. This, of course, is in part a legacy of recent crises, such as the Great Financial Crisis and the COVID pandemic. However, and whatever the cause of high and increasing levels of government debt globally, it does present challenges for both fiscal and monetary policy. So we have to ask ourselves, what are the resulting risks to price stability and fiscal sustainability? And as we've heard, or we discussed yesterday, to central bank independence. And what should central banks and governments do to achieve their goals? And how should they take into account the other governments' agencies' actions to achieve the best possible outcome from the standpoint of society as a whole? Fortunately, we can draw on economic research to guide us when addressing these difficult questions. One of the researchers who's worked extensively on optimal policy questions, and in particular related to monetary policy, is Daisuke Ikeda, who I'm very pleased to introduce as a speaker here today. He's a senior economist at the Bank of Japan and heads the Economic and Financial Studies Division of the Institute of Monetary and Economic Studies, the very institute whose guest we are today as part of the conference. Daisuke, in his wide-ranging research, helped to deepen our understanding of topics related to monetary policy, asset price bubbles, financial stability and macroprudential policy, but also on effects of demographic change, typically with a particular focus on Japan. So I'm very happy to welcome Daisuke to the floor, and I'm really looking forward to your presentation.
Okay. Good morning, everyone. I'm very honored to present this paper to you all. Again, my name is Daisuke Ikeda, Bangkok, Japan. Typical disclaimer applies. The views expressed in this presentation are mine. So in the first half of this decade, we went through a global surge in inflation. So inflation remains higher than the target level in many countries. Despite inflation targeting frameworks, inflation can deviate from the target persistently. Two potential causes have been pointed out. The first is supply shocks, which have been intensively discussed at this conference yesterday and today's morning. And the other is monetary fiscal influences, which I'm going to focus on in this presentation. As the government debt has increased worldwide, monetary fiscal influences deserve examining. So far, the recent literature has tackled monetary fiscal influences by focusing on non-Ricardian households. As is well known, in representative agent New Keynesian models, so-called rank, government bonds have no role to play. Increasing government debt has no impact on inflation and output in the rank model because households are Ricardian. So the literature has increasingly turned to heterogeneous New Keynesian models, so-called HANKs, where households are non-Ricardian. In this case, for non-Ricardian households, government bonds are net assets, and increase in debt is expansionary, increasing output and inflation. And recently, Angelitos, Liang, and Wolf, they showed that a HANK model, under some conditions, can have a very similar implication to the fiscal theory of the price level, FTPL. So HANK models and the presence of non-Ricardian households have enriched our understanding of monetary policy. But so far, the literature has predominantly focused on targeted equilibrium, where inflation fluctuates around the target level, typically 2%. But given the possibility of persistent deviations in inflation from the target, I think it's worth broadening the scope of equilibrium beyond a targeted equilibrium. So this is a bit of new but small perspective, new perspective in line with the conference theme. So specifically, I'm interested in whether there is any force that persistently or permanently pushes inflation up or down. To examine this, I study an analytically tractable HANK model that is perpetual youth overlapping generations, OLG version of New Keynesian models, with focus on monetary fiscal interactions and the potential existence of unintended equilibria, non-targeted equilibria. So my main findings can be summarized in 3 points. The first, with non-Ricardian households, multiple steady states may prevail. A targeted steady state always exists, but depending on monetary fiscal interactions, there may exist a high or low inflation steady state. And specifically, when the stabilization stance of either monetary or fiscal policy is relatively weak, then high inflation emerges. And second, I analytically characterize the properties of local dynamics around these unintended steady states. The key concept is determinacy, the uniqueness of equilibrium around steady state. Determinacy is crucial for price stability because indeterminacy, in contrast, means multiple equilibria, complicating central banks' efforts to stabilize inflation. So when both monetary and fiscal policies' stabilization stance is relatively strong, a targeted steady state is determinate. But when either policy's stabilization stance becomes weak, then a targeted steady state loses determinacy and features explosiveness, and then high inflation emerges with determinacy. A low inflation steady state, if it exists, is prone to indeterminacy or explosiveness. Third, I also study self-fulfilling deflationary equilibria and find that there exists one deflationary equilibria with determinacy, which makes contrast with rank models where deflationary steady state is always indeterminate. So these are theoretical results, but may inform monetary policy. So specifically, the existence of multiple steady states suggests the risk of inflation becoming unmoored in spite of inflation targeting frameworks. When a targeted steady state loses determinacy due possibly to the weak policy stance of either monetary or fiscal policy, then inflation can deviate from the target upward persistently, leading to high inflation for a prolonged period of time. But low inflation is less concerning because low inflation steady state is, it lacks determinacy. However, there may exist a deflationary steady state that exhibits determinacy. So if inflation falls too much, then the economy may fall into deflationary equilibria, so highlighting the importance of anchoring inflation expectations at the target. So my model is very simple, building on perpetual youth OLG models studied by Yari, Blanchard, and Weil, and extended to incorporate monetary fiscal interactions. The model embeds rank model as a special case, so it is comparable to Leaper's 91 paper. And recently, several papers use the same framework, Hank OLG perpetual youth framework, to study monetary fiscal interactions. But as I said, they mostly focus on targeted equilibrium. But my focus here is on non-targeted equilibria. So the rest of my talk is organized as follows. I present the model and then show the main results on the positive interest rate equilibria, starting with steady states and then determinacy. And if time allows, I briefly touch on self-fulfilling deflationary equilibria, then conclude. So as I said, the model is a perpetual youth OLG version of New Keynesian model in discrete time. I want this model as simple as possible, so nominal rigidities and fundamental shocks are abstracted away. So there are 4 types of agents. Households work, consume, and save. Firms are competitive and produce output using labor. A central bank, of course, is independent and sets nominal interest rates. And the fiscal authority issues one-period nominal bonds and adjusts a lump sum tax. So far, the model is very standard. A key feature of this model is the presence of non-Ricardian households. And specifically, households face mortality risk 1 minus omega. And so, on average, the lifetime is not infinite, but the finite lifetime. And every period, a fraction 1 minus omega of households exit the economy, and the same number of households enter the economy, so that the population remains constant. When surviving probability omega equal 1, then which means 0 mortality risk and infinite lifetime, then the model is reduced to a rank model. So this model embeds rank as a special case. So this is a household problem. So household chooses consumption C and hours worked N, and the amount of nominal government bond holdings, capital B, to maximize the sum of discounted utility subject to the flow budget constraint, which is consumption plus government bond holding is equal to wage income plus the return from the government bonds held from the previous period plus social fund transfer net of lump sum tax tab. So here we have social fund transfer just for simplicity, making the model to comparable to a rank model. So it is modeled as a transfer from incumbent households to a newly born households. The firms have a linear technology producing output Y using labor N. And because of perfect competition and flexible prices and flexible wages, in equilibrium, the real wage, output, hours worked, consumption all become equal to unity. and constant. So in this model, our focus is not on the real economy, but more on the nominal interest rate, inflation, and government debt. The central bank sets a nominal interest rate following a simple rule, responding to inflation pi in deviation from the target pi star. And here, parameter phi governs how strongly central bank responds to the deviation. So this parameter captures the stabilization stance of monetary policy. And the zero bound constraint is imposed. The fiscal authority issues nominal government bonds and collect lump sum tax to finance government bonds. Its interest and principal payments of government bonds issued in the previous period. And government sets a lump sum tax here, following a very simple rule, responding to the amount of debt in real terms in deviation from its target, B star. And here, because output is constant at unity, you can interpret B as the outstanding amount of debt or debt GDP ratio. And here, parameter theta governs how strongly fiscal authority responds to the deviation. So it captures stabilization stance of fiscal policy. And there is a fiscal limit because simply this is a feasibility constraint because, for example, tax cannot exceed GDP. A competitive equilibrium in this economy can be summarized in 3 equations: the aggregate Euler equation, monetary policy rule, and fiscal policy rule with 3 unknowns: inflation, nominal interest rate, and government debt. And monetary and fiscal policy rules are standard, except for the explicit consideration of zero bound and fiscal limit. The key feature lies in aggregate Euler equation, specifically the presence of parameter chi. Chi depends on surviving probability omega. And when surviving probability is equal 1, then chi is 0, reducing this Euler equation the standard rank case, the familiar one. But here we consider the finite lifetime horizon for households, making them non-Ricardian. And so omega is less than 1, and chi is positive, making this Euler equation depend on government debt. And specifically, when real interest rate goes up, then households would like to save more today and consume more tomorrow, and leading to more government bond holdings. So this is because in this model, government bonds are net assets for these households. Government bonds are backed by not only by taxes imposed on the current generations, but also backed by taxes imposed and paid by future generations. And so in response to a rise in real rate, incumbent households respond by holding more government bonds and consume more tomorrow. Okay, now let us examine positive interest rate equilibria, starting with steady state. So let's ignore zero bound and focus on the situation where interest rates are positive. And then substituting out nominal interest rate using a monetary policy rule, then the 3 equations reduce to 2. The one is Euler curve, this corresponding to the aggregate Euler equation. And the second is the fiscal curve, corresponding to fiscal policy rule. Both are expressed as B over pi as a function of inflation pi. And the steady state is given by the intersection of these 2 curves. Okay? And it's very straightforward to see that pi star is a solution to these 2 curves. And so pi star is a solution, so meaning that a targeted steady state always exists. But the shapes of the 2 curves depend on whether monetary policy parameter and fiscal policy parameter are greater than 1 or not. So let me start from a typical case where both parameter values are greater than 1, corresponding to active monetary and passive fiscal policy regime according to Leaper's terminology. Okay, so this figure plots fiscal curve and Euler curve. And the Euler curve in the case of rank, when omega equal 1, the fiscal curve is upward sloping because when inflation rises, then central bank raises nominal rate and real rate, and prompting government to issue more debt to finance the interest payments, higher interest payments, so upward sloping. And the Euler curve is vertical, meaning that real interest rate is constant at 1 over beta, as in the representative agent New-Keynesian model rank. So you can see there is only a targeted steady state only. But if we allow for non-Ricardian households, then the Euler curve shifts clockwise. And if we lower the value of omega further, still there is only a targeted steady state. But when omega is equal to 0.85, then a low inflation steady state emerges in addition to targeted steady state. And if you lower omega further, then there will be a higher inflation steady state. And when omega is 0.75, even higher inflation steady state emerges. So what is the intuition about the existence of unintended equilibria? So especially I'm interested in high inflation steady state. So in the case of omega equal 0.75. So I'd like to add that these values of omega are empirically relevant. Okay? So in this illustration, there are two steady states, targeted steady state and high inflation steady state. So let's start from the 2% targeted steady state. And from here, if there is a slight increase in inflation, then the central bank responds by increasing nominal rate and real rate. But observing the increase in real rate, households respond by increasing the holding of government bond because this Euler curve is upward sloping. But the government issues even more debt because the fiscal curve lies above the Euler curve. So the supply of government debt is greater than the demand of government debt. So this leads to higher inflation. And then central bank raises interest rate more, and real rate goes up, and households hold more government bonds, but still the government issues higher debt. And this cycle continues until the demand becomes equal to supply at this new steady state. So two things are essential for the existence of high inflation steady state. One is non-Ricardian households, which makes this Euler curve from vertical to upward sloping. And second is, as you can see, the concavity of fiscal curve. The higher the inflation, the higher the real rate, and greater the government bond issuance, but at a slower pace. So this pattern is generated from the tax rule that responds to the deviation of debt stronger as the level of debt becomes higher. And this pattern was initially confirmed by Bohn's 98 paper. Okay, so let's move on to the different regime when monetary policy parameter is less than 1. Okay, in this case, the real rate is decreasing in inflation. So the Euler curve and the fiscal curve are downward sloping, but you can see when omega is low enough, then there can be low or high unintended steady states. And in other cases where fiscal policy parameter is less than 1, corresponding to active fiscal policy in the terminology of Leaper, it can be shown that there is only targeted steady state only. And then these figures summarize what I explained so far. The x-axis is monetary policy parameter, and y-axis is fiscal policy parameter. normalized by 1 minus beta, and in the rank case, omega equal 1, and the hunk case, in the case of omega equal 0.8. In the rank case, you see there is only targeted steady state only. So that's what we know. But in the case of hunk, you can see vast areas of the existence of high or low inflation steady state. And in particular, when fiscal policies stabilization stance is relatively weak, then high inflation steady state emerges. And when monetary policy parameters stabilization stance is relatively weak, again, high inflation steady state emerges. And then the existence of these unintended steady states raise new questions. Does the economy diverge from a targeted steady state? Then does the economy converge to an unintended high or low inflation steady state? And once the economy becomes close to unintended steady state, are the dynamics around unintended steady state stable or not? So I address these questions with a focus on the concept determinacy, the uniqueness of equilibrium around steady state. So let's start from the determinacy properties of targeted equilibrium. And this is a familiar one in the case of rank. So this figure summarizes, the left figure summarizes the result of Leaper. When monetary policy parameter values satisfies Taylor principle greater than 1, then you can see the vast area of determinacy. But if it violates Taylor principle, then indeterminacy ensues. And there is a small region, left bottom area. This corresponds to the FTPL regime. But when we allow for non-Ricardian households, in the case of hunk, you can see that determinacy and also explosive regions expand. So this is the result recently shown by Rachel and Raven about a targeted steady state. But my contribution and my focus here is on determinacy properties of unintended equilibria. So this figure is taken from the previous one about a targeted equilibrium, and the right figure summarizes the determinacy property of unintended equilibria. So there are 4 points, A, B, C, and D. So let me start from point A. At point A, a targeted steady state is determinate, and there is no unintended steady state. So there is a unique targeted steady state with determinacy. So that's fine. And then if the economy moves to point B, as the monetary policy stabilization stance becomes strong, then of course targeted steady state remains determinate. But here, low inflation steady state emerges. But it exhibits explosiveness, so the economy diverges away from this low inflation steady state. So low inflation is less concerning. But if the economy moves from point A to point C, as the fiscal policy stabilization stance becomes weak, then the targeted steady state features explosiveness, so diverges away from a targeted steady state of 2%. And then high inflation steady state emerges with determinacy. And so if inflation goes up and the economy becomes close to this high inflation steady state, the economy likely stays around this high inflation steady state. And finally, if the economy moves from point A to point D, as the monetary policy stabilization stance becomes weak, then a targeted steady state exhibits indeterminacy, and high inflation steady state emerges with determinacy. So these risks of inflation are moved from the target. Okay, so the key message here is that there can be multiple steady states, especially high inflation steady state, and there may be the risk of falling into high inflation equilibrium if either monetary or fiscal policy stabilization stance is relatively weak. So I think I have still a few minutes, so let me just briefly touch on self-fulfilling deflationary equilibria. So idea is that if people expect deflation for some reasons, and if deflation is realized, central bank responds by lowering nominal interest rates, but it hits the lower bound. And under the lower bound, deflation means a higher real rate. So putting downward pressure on inflation, so making deflation self-fulfilling. So we can do the same things as we did before. So we can draw Euler curve and fiscal curve under the zero interest rate, okay, here. And then we can draw a fiscal curve and Euler curve. In the case of rank, okay, the Euler curve is vertical. And you can see that there's only unique deflationary steady state. And it is known that this steady state is indeterminate. But if we allow for non-Ricardian households, then two steady states emerge. One is mild deflation steady state, and the other is severe deflation steady state, okay? Like this. So because of the time, I don't show it in detail, but we can show that these mild deflation steady states are determinate, and these severe deflation steady states are indeterminate. And also the interesting feature is that in a mild steady state, the real rate is lower than the targeted steady state. So if the economy moves from targeted steady state to mild deflation steady state, you will observe a decrease in real interest rate. So consistent with the Japan's past experience. And then these figures summarize the existence of these deflationary steady states in the case of rank and in the case of Hank. And you see the vast parameter areas, monetary policy and fiscal policy parameter combinations, where especially mild deflation steady state emerges, exists, and which is determinate. And so implication is that if the economy falls into this determinant deflationary steady state, then the economy likely stays around this deflationary steady state for a prolonged period of time because it features determinacy. Okay, so let me conclude. So I study Hank OLG model, focusing on monetary fiscal interactions and the potential existence of unintended equilibria. So specifically, high inflation steady state, which is determinate, such a steady state can emerge when the stabilization stance of either monetary or fiscal policy is weak. And low inflation steady state is less concerning, but there may exist deflationary steady state with determinacy, so highlighting the importance of anchoring inflation expectations at the target. Thank you.
Thank you very much, Daisuke, for a very rich and thought-provoking presentation. Now I'm very pleased to introduce the discussant of the paper, Fernando Martin. Fernando is Senior Economic Policy Advisor at the Federal Reserve Bank of St. Louis, and one of his key research areas is fiscal and monetary policies, so a perfect match. The floor is yours, Fernando.
Match made in heaven. Okay, thank you very much. It's a pleasure to discuss this very timely paper. And at the heart of the paper is the old question of what determines inflation. And to answer this question, I think the interaction of fiscal and monetary policies is key. Okay, and we have some classic insights from the literature that basically dates back to Sargent and Wallace and then Lipper and Sims, telling us that there is the potential that ultimately inflation is a fiscal phenomenon, and this is where we derive also the concept of active versus passive fiscal and monetary policies and fiscal and monetary dominance. Now, we are like two big strands of the literature, New-Keynesians on the one hand, fiscal theory at the price level, or monetarism, classic monetarism on the other, and they emphasize, different aspects or sides of this monetary and fiscal interaction. And at the end of the day, it boils down on whether you bring fiscal policy to the foreground, forefront or the background. So is fiscal policy, unrelenting, or is it like adjusting to monetary policy? And they have different implications at the end of the day on who controls inflation and what inflation is. there are some recent attempts to kind of bridge these two literatures, which I appreciate. And Daisuke's paper is basically framed in this context. And the idea is really, can these interactions themselves lead to unintended equilibria? Okay, and that's the question. Okay, so this is a technical paper. So let me be technical just for a few slides, and I promise you there is light at the end of the tunnel. So the model is very stripped down, very simple, which I really appreciate. Just like Ivan, I like simple models with clean mechanisms, and this is one of them. So the main aspect of this model, it has flexible prices, has nominal debt, but it's really about, the risk of mortality. So agents here may die, and they engage in perfect insurance for their bond holdings, okay, which means, that if they die, their bonds are redistributed to the present living, not to the newborns, but to the present living. So what that implies is that, you can characterize the steady state of this economy with just 3 equations, right? So I'm going to go bottom up. You have like a monetary rule, that's your, Taylor rule, right? Then you have a fiscal rule, which basically tells you, well, taxes react to where debt is relative to some target, and that reaction is governed by this parameter theta, which tells you how responsive the fiscal or how correct the fiscal policy is. And then what you have is a slightly unusual Euler equation, which typically links, nominal interest rates. It's the one that determines the real rate, right? So it links nominal interest rates, inflation, and the real rate. And what you see is this, funky object here, this chi, right, which is basically a function of, mortality risk. Okay, so when people don't die, when they live forever, this chi would be 0, and then what you have is a standard Euler equation that basically tells you the real rate is just the inverse of the discount factor, and that's the end of it. But when you open up, the risk of mortality, then you get this wedge here, which tells you that, well, if steady state debt ends up being, and inflation ends up being kind of different from your target, the real rate may be different as well. So let me explore that. So like I said, if you have a plain vanilla rank model, then you get the standard Euler equation. The real rate in steady state is pinned down by the discount factor. You plug in your Taylor rule, and that's the end of it. Inflation is equal to the target, and you're good. Now, when you have mortality risk, what happens is that, well, you need to now allow for the possibility that, maybe, the steady state is not really the targeted one. And what happens in this steady state is that real rates affect desired bond holdings, as Daisuke explained. Basically, it all boils down to, government bonds being net wealth for households that are alive today, okay? And that leads to the potential for the real rate being different from the discount factor in steady state. More importantly, what you can notice is that once I open up this equation and let this be non-trivially 0, what happens is that you cannot solve for debt holdings and inflation independently. So they're solved jointly by this Euler equation and the fiscal rule, and then it opens up the possibility that maybe there's more than one solution. Turns out sometimes there is one, sometimes there is 2. Okay. So one thing you can do is rewrite these equations as deviations from the targeted steady state, okay? So I'm going to rewrite the previous equations as basically solving for B according to the 2 equations, and this is the deviation from the target, as a function of where inflation is relative to the targeted inflation, okay? So what you get is 2 equations, and when they coincide, that's your solution. So what's the target equilibrium? It's going to be when the pi hat and the b hat are 0. So the origin gives you your targeted equilibrium. But it may be possible for these 2 curves to basically cross at different places. What's nice about this representation is that the slopes of these 2 functions, because they are deviations from steady state, those slopes are the same coefficients that govern the local linearized dynamic system, which means that with the same equations, you can talk about the steady states, and you can talk also about the determinacy, okay, just by looking at the relative slopes of the 2 curves. And that leads me to a slightly different version of the graph you just showed with all the regions. So typically we see like all these regions here. What I'm going to do is kind of a similar graph, but with curves that capture both the 2 steady states and their stability properties. So Think of this axis here as, if you go in this direction, what you get is a more responsive or active monetary policy. If you go in this direction, you get a more responsive or passive fiscal policy. So you go in this direction, you get a more active monetary policy, more passive fiscal policy. If you get somewhere in between, what you get is just a plain vanilla result. You get one steady state is your target, and you're good. Okay, so the only steady state is the origin. Remember, I'm doing this in differences from steady state. But if you move along this line, so either a very active and very responsive fiscal policy, you may have two equilibria, okay, two steady states. But the targeted one is still stable, okay? That you can see how it would work out. Same thing here. You can go in the other direction. You get one stable, one unstable equilibrium. So what's more worrying is that, well, you could have a very kind of passive monetary policy and a very responsive fiscal policy, and then you get that the stable steady state is actually one in which you have high inflation. Or you could have another situation in which, you have a very responsive monetary policy, a very unresponsive fiscal policy, and the stable steady state is one with high inflation. And those are the ones that Daisuke was explaining to us were a source of concern. So now the question is, why do we get this result? Is it really about requiring equivalence, or is it something else? So it turns out that it's not sufficient to just break Ricardian equivalence. So one thing you can do is just try other ways of doing it, and I chose the obvious one. Say you put distortionary taxes on income or consumption, or suppose you have a tank model with hand-to-mouth, et cetera, and they don't work. Why? Because if you do that, you still get an steady state. The real rate is pinned down either by the discount factor or some version of that. Okay, you can have like the mortality rate there. So I did find one more alternative, which kind of speaks to what's going on in the mechanism. And it's, for example, suppose bonds have a liquidity purpose, so they have a service, which means now, the real rate of return on bonds may depend on the quantity and still matter in steady state. So what really matters is not just that houses are non-Ricardian, but also that in steady state, the real interest rate is a function of the quantity of debt. Because when it's not, then you go back to the standard model, okay? So what does it all mean? So I like the classics, so let me go through the good, the bad, and the ugly. So the big result here is that the stance of fiscal and monetary authorities may lead to stable, non-targeted equilibria. So you're going to be in a situation that you don't want to be. The good thing is that monetary policy stance still matters, right? So if you are aggressive in your monetary policy response, you're more likely to be in a stable region for your targeted equilibrium. The bad thing is that, well, if fiscal policy is sufficiently unresponsive or if monetary policy is weak, that may create a stable high inflation equilibrium, which you didn't intend to obtain. What's the ugly? What's ugly is the data. So where we are now, that's where I'm going to move next. So Daisuke basically raises the risk of both low or high inflation equilibria. I'm going to focus more on the US as an example of whether it's possible that we have a high persistent high inflation equilibrium. Just to look at data through the lens of the model, right? So this is the US fiscal outlook. You've probably seen some version of this before, but what this is basically telling you is that before the financial crisis, which happened here, primary deficits were followed by surpluses. So on average, the primary deficit in the US was about 0. After that, we had two subsequent crises, the global financial crisis and then COVID, which implied an permanent increase in debt over GDP that was not corrected, and then a trajectory that does not look as corrected. Okay, that there is no appetite for correcting kind of the expansion on government debt. So an expansive and unresponsive fiscal policy. So check one. What's the other one? Well, monetary policy. This is inflation and the federal funds rate, right? You've seen a graph like this. So you get a Volcker disinflation, you get Greenspan reacting to the business cycle, you get the zero lower bound era, and then what you get is COVID, where the reaction was a little bit late, and then now we have the looking through type of policy for certain supply shocks like tariffs. So let me focus on the post-COVID experience, and I actually like to look at the price level rather than inflation. I think it's more informative for this purpose. So what I'm drawing here is the price level, just excluding energy, because it just creates unnecessary volatility. And it's normalized to 0 to February 2020, so right before COVID. And what you can identify, and we can talk about how we can do this, but what you can identify is 3 periods. One was the low inflation period, where the trend is basically 1.5, which is below target. Then the COVID period, which was a shock, so inflationary. And then afterwards, a period of inflation above target, so kind of high. So we seem to be stuck now in a persistent situation in which the outlook for fiscal policy is expansive, and at the same time, monetary policy may not be doing enough to kind of bring down inflation to something closer to the targeted steady state. So let me go back to the question of who controls inflation, and I'm going to conclude with this slide. So what we have in the data is persistent and large deficits, like I said, and inflation persistently above target. So why are we here? Well, central banks have been accommodative to fiscal responses during the last 2 big crises, which is not itself necessarily a bad thing. You may think that the fiscal policy expansions were socially optimal, right? So imagine that, especially during COVID, fiscal policy was trying to insure agents against, things that the market was not insuring against, like a pandemic. So would you really want to lean against that? Maybe not. But the cost, of course, is inflation, which is one way to pay for a fiscal policy that doesn't get paid with taxes. So you need to pay it somehow. So what's the key? Well, even if you think it's optimal to basically allow fiscal policy to address a big, large, unanticipated crisis, what's going to be key afterward is having the discipline that once the crisis is over, you kind of recover your commitment to price stability and inflation, or the inflation target. And I put commitment in scary quotes because I mean kind of a soft version. I don't believe in strong commitment, but it's more like it's intention, it's your objectives. You have to mean it and be proactive in showing that you do. But there's still time consistency problems, so you need to think about that too. Of course, the open question then is if we don't do that, what happens as the confidence in the target is eroded. So just to conclude, what this paper does is warn us that it may not be enough to have a strong monetary policy. It's really the combined stance of fiscal and monetary policy that determine whether you are where you want to be, or you may converge to a stable equilibrium with undesired inflation. So that opens up the question for society, for institutions, in how do we restore that fiscal responsiveness that once you look at the data, doesn't seem to be there. And that's the key question for the future. Thank you.
Thank you very much, Fernando, for this great discussion. Before I hand back to Daisuke to respond to the comments, I'd like to already invite everyone to think about their questions. But before that, back to you.
Yeah, thank you very much, Fernando. You are very insightful discussions. So first thing is that you have more simpler representation of Euler and fiscal curve. That's useful for analytical purposes. So I like it very much. And also your point that the non-Ricardian households, it is necessary but not sufficient. So I think it's very useful to have in mind that other representations such as bonds in utility may generate multiple equilibria. That's a very good point. And finally, related to your last point, so I maybe just for food for discussion, in my presentation, I consider 4 points, A, B, C, and D, if you remember. And so there may be worth considering other points, like point E, where both monetary and fiscal policy responses are relatively weak. Then, at least in this model, targeted steady state continues to be determinant. But there may be an issue that in this determinate steady state, inflation is actually fiscal driven, and so that in response to a change in debt, inflation and output responds more strongly, and so inflation and real economy are more affected by fiscal conditions in this determinate steady state where both policy responses are weak. So whether we are in such a situation or not, it's an empirical question, but I just want to raise an issue. Thank you.
Thank you, Daisuke. I'm now opening the floor to questions and comments, and I see Ivan.
Okay, thank you. Enjoyed the presentation and the discussion, and I have, I guess, 2 questions. One is, how much is this about Hank? If I can think that you also had in Leaper the region where if fiscal policy doesn't respond and we satisfy the Taylor rule, we have this explosive thing that we never look at. Is this just making the equilibrium that there is somewhere at infinity come to a finite number, and so now we start to pay attention to it? That would help me understand what the role is in, because I think I lack a little intuition for what we're expecting to see along the transition. Understandably, you gave us the steady states and then just told us whether they're but I think understanding that mechanism to me is important. And if we never cared about that explosive region, suddenly now it looks like this is just changing the role of that explosive region. But do I have the same maybe aversion to the intuition that I implicitly had when it was an explosive region? Is my question. And then the other thing is, if we rely on income effects, I would like a lot more care taken in thinking about whether things work out the way they do in this simple model. And I agree you need a simple model, I'm all for it, but you always want a simple model to understand what the assumptions are being made also. And here it feels like, yeah, people have more bond holdings, they consume more. But that's, if I think of government debt held by foreigners or very rich people, I start to wonder, and taxes being raised but not sufficiently, or maybe welfare programs being, but that's affecting the people who actually do have a high MPC, so it could go the other way almost. I'm just starting to think through this. Imagine debt's going up and we raise taxes not enough, but the people who pay those taxes are the middle class that will lower their consumption instead of raise it. The people who are accumulating this debt, becoming richer, they're just going to inherit, bequest it and not spend it. So that's kind of the thing I'm thinking about. If you've given any thought to that kind of correlation pattern or foreigners, et cetera. Thank you.
Thank you. Especially the first question about the transition possibly from targeted steady state to high inflation. So at this point, I study only local dynamics. So I haven't studied, global dynamics. But I would expect when high inflation steady state emerges, then the economy moves from targeted steady state to high inflation. And my understanding is that this high inflation steady state is an intermediate situation between targeted steady state and explosive region. And explosive dynamics was studied by Loyot's 1999 paper, and hyperinflation, the Brazilian economy case. But here, as an intermediate case, there may exist high inflation steady state where both the supply and demand of government debts are equated. And the second point is, I think, more important because in practice, higher debt doesn't necessarily mean higher consumption. As an experience of Japan, debt GDP ratio was around very low, 20-30% in the beginning of 1990s, but now a lot higher. And so I think to explain this, we have different model allowing for a change in demand for government bonds due to possibly demographics. But I agree that this is very simple model. So the next step would be to have, for example, quantitative OLG model or quantitative Hank model that features upward sloping Euler curve, and whether these quantitative models, whether there is any unintended steady state that's worth exploring. Thank you.
We have 3 more questions. Marcus first.
You have some short questions. So you introduced the zero lower bound. How critical is it? And if you do it, is the intuition the same as the Jim Bullard paper intuition for the multiplicity in your setting as well? And my second question is there any connection when you show the multiplicity where the real interest rate is below G? Is the R versus G connection you can draw here as well or not?
From the second question, I exclusively focus on R is greater than G in this setting. So there is a paper considering R less than G. So in that case, government debt has a bubble term, as in your paper. But here, R real interest rate is always greater than G. And the deflationary steady state intuition is the same as Jim Bullard study. But here, because of non-Ricardian households, determinant steady state, deflationary steady state is determinate, opposed to indeterminate deflationary steady state in the rank model, Bullard's and other Schmidt, Grohe, Riebe, and Ben Habib's paper.
Mr. Fujiwara, please.
Okay, my question is related to the Marcus' first point, and Daisuke, you just answered. So that I would like to still seek for the active monetary policy can do given the passive fiscal policy. Then, so you just mentioned the Ben Habib Schmidt Grohe kind of the word. Then, one lesson we have learned is that if the central bank follows the really history-dependent policy or price level targeting, we can avoid the multiplicity of the equilibria. So I fully don't understand the intuition yet, but if the central bank follows the history-dependent monetary policy, can you avoid the multiplicity of equilibrium? So my question in general is that, is there any monetary policy rule which can avoid the multiplicity?
At this point, I haven't explored whether there is any monetary policy rule that avoids deflationary or high inflation steady states. But here we focus on steady states. So I think if you consider other monetary policy rules, I think there would likely be still multiple steady states, but needs to be considered. Thank you.
And finally, we have a question by Mr. Shiochi.
Thank you. Very interesting paper. So let me start with an obvious question that, omega, the situation that you're interested in, omega is equal to 0.8. If you interpret this situation literally, 20% of the population dies each year. And I suspect you don't really mean that. But so what's the real world interpretation of this parameter, and how realistic is it? I mean, it sounds like you are making a very strong assumption. And the second question is somewhat related to the previous one, but here you just restrict the monetary policy rule as some kind of a log linear version. But suppose that you cannot do anything about the fiscal policy. We cannot control what the politicians do. But can we just tweak the monetary policy rule equation, introduce some kinks of discontinuity? Can we think of a rule that can avoid multiplicity? So that's my second question. Thank you.
Yeah, thank you. The second question is important, as Fujiwara-san also pointed out, and I think at this point I consider only simple version of monetary policy rule. So there may exist, different, more sophisticated monetary policy rule that avoids multiplicity, but it's open question. And secondly, about omega. So in this literature, we don't interpret omega as I said surviving probability, but not interpret literally. So it's well known that OLG model is very similar to, can be interpreted as heterogeneous agent models with binding borrowing constraints. And so Ivan has a paper showing that in this perpetual use model can be interpreted as Hank model with borrowing constraints. So the omega can be interpreted as the 1 minus omega can be interpreted as the probability of hitting borrowing constraints.
I think we are reaching the end of the session. Although I want to check if Ivan wanted to come back in or if it's still the sign up from the previous intervention. Oh, okay, good. So with this, please join me in thanking the presenter and discussant for a thought-provoking discussion, and thank you for the engagement.